Pamela, I'll be doing accounting paper one, which is this year's accounting paper. In the video for today, I'll be focusing more on question two. Now, question two is all about financial statements. 21 minutes for 43 minutes. We've got information relating to Mkhize Motors Limited, public company. So Mkhize Motors Limited is a South African listed company that trades in small to medium-sized electrical motors that are used in commercial products. They have an authorized share capital of 6 million ordinary shares. Now, if I was asked the share capital note, I don't see any share capital note here. So if I was asked the share capital note, I was going to record that under authorized, but I wasn't asked the share capital note. As you can see, this is all we have and what we are asked to do. So this is all we have to do. For now, that information is immaterial. I can't use it at all. They add a standard markup of 200%. Highlight that on the cost of all goods. Their latest financial year end is the 28th of February 2023. But then they gave us extracted balances from the financial statements on the 28th of February 2022. I need you guys to understand that these are balances at the end of 2022. And our current financial year is the 28th of February 2023. Please notice that the end of 2022 is the beginning of 2023. So all these balances that we are given here are opening balances on the 1st of March 2022, which is the beginning of the financial year. You got it. So none of the adjustments that we are going to read have been included in these balances. These are just opening balances at the beginning of the financial year, which is the 1st of March 2022. If I had the share capital note, I was going to take this to the share capital note. This one will go to retained income. If I had tangible asset, I will take these two to tangible asset note. This one, I can't put it anywhere. I'm going to compare to current year provision for bad debts. This one I need to read as to what happened. So if we have consumable stores, these are consumable stores that were not used last year. So they were current assets last year, but this year they'll be the first ones to be used. So they will be part of your expense. And we will add that 1,250 to consumable stores and operating expenses. Then they gave us information about the current financial year. So all these balances are right at the end of the current financial year. They gave us trading stock, they gave us trade debtors, sales income tax. These are provisional payments. When you see debit, you must just know that 586,300 represents your provisional payments. The loan amount is 288,000. Creditors control is 714,000. Under nominal, everything under nominal must be recorded in your statement of profit or loss, except for the obvious that I will state shortly. So when I looked at my profit or loss, sales is there, cost of sales is there, fee income is there, rent income is there, discount received is there. but we don't have consumable stores. So let me see if we have consumable stores here. We do of 45,700. So I will take that and put it in brackets over here. Right? We good? Laka. Okay. Um, so after consumable stores, we've got discount received. That is under income, discount allowed. That was under expenses. It was recorded. Oh, there's debtors allowances of 420,000. What do we do with that one? Mm, work with me here. Say it. What are we going to do with that 420,000? We are going to subtract it from sales. Well done. See? Easy. 1 mark. Just like that. So I'm basically done with everything here. I'm going to move to the next section. So this next section is about, let me just read. It says additional information relating to shares and dividends for the year ended 28th February 2023. So it says that on the 31st of May, the company issued 1 million shares at 8 Rand 96 cents each. I know that can be confusing. Why are they giving us this information when they never asked for your ordinary share capital note? On the 30th, it says the company declared and paid an interim dividends totaling 928. And these interim dividends, I also saw them here as ordinary share dividends, which amounted to 928,000. When you see dividends that are reflected under nominal account section in your pre-adjustment trial balance, just know that those dividends are interim dividends. What did I say? What are they? Apologies. My internet connection is a little bit unstable today because of the rain, and it's rain, free air here. I don't know if I don't know if it recorded what I said, the last statement I said, because I was talking about ordinary share dividends that appear in the pre-adjustment trial balance of 928,000. So that 928,000, it is basically your interim dividends. And this on the 30th of September, what I highlighted here indicated that this actually is your interim dividends. Interim dividends are the only dividends that will be declared and paid. And remember, whatever appears in your pre-adjustment trial balance, especially in the nominal account section, represent what has been received or paid. Got it? Good. So where are we going to record those interim dividends? Where do we record interim dividends? Interim dividends will be recorded in retained income under ordinary share dividends. I prefer to call it dividends on ordinary shares. So I will have interim dividends and the amount will be 928,000. Done with that. On the 1st of February, the company bought back 250,000 ordinary shares at 9 Rand 95 each. So that 9 Rand 95 represents the buyback of shares, right? It was negotiated that these shares will qualify for final dividends. Highlight that. But the buyback of shares, everything here that we have read, especially the issuing of shares, does not affect anything that we're dealing with, right, Jim? But everything that we have done or read above does affect retained income. You will never be able to calculate what goes to retained income without the information above. So after all, you might have to prepare your ordinary share capital note as part of your workings so that you can calculate EPS. EPS is your average price per share, APPS. When it comes to shares that are issued, because APPS is about the number of shares that are issued, we've got opening number of shares of 4 million, and the share capital relating to that was 37,440,000. So that will be included when I calculate my EPS, which is here. So EPS will be made up of ordinary share capital at the beginning of the year, which is 37,440,000 divided by the number of shares issued at the beginning of the year. That will be 4,800,000. Did we issue any shares before the buyback? Yes, on the 31st of May, 1,000,000 shares issued at 8 Rand 96 each. So in the numerator, the share capital will be that million multiplied by 8 Rand, 96 cents, which will give us 8,960,000 divided by the number of shares that were issued, which will be 1,000,000. Was there any issue of shares before the buyback beside those two? No. So basically, we're going to simply close it off and just calculate our EPS. EPS here will be 8 Rand. But remember, BBS, the buyback price will be 9 Rand, 95. So we bought back these shares at 9 Rand 95, or else we only received 8 Rand for them initially when we sold them. So we pay more than what we initially received. If that is confusing you guys, please check out videos under ordinary share capital. I think I've got examples in classwork 1 up to classwork 12. Check them out. You will notice that here we made a loss, and our loss will be the difference between that 9 Rand 95 and 8 Rand. And that loss will be recorded in your written income note. You will take that 9 Rand 95 minus 8 Rand multiplied by the number of shares that were bought back. How many shares were bought back? 215. But because it is a loss, you put it in brackets. Great. That's it with respect to the buyback of shares. Let's move on. On the 28th of February, which is the last day of our financial year, we declared final dividend of 18 cents per share. I need you to go back to the 1st of February where they say those shareholders, those 250,000 shares that were bought back, or shareholders, they qualify for final dividend. So we don't subtract them. So number of shares issued will be number of shares at the beginning of the year of 4,800,000. You add it with the new shares that were issued, which was 1,000,000. You don't subtract the 250 because they qualify for final dividends. If they just said final dividends amounted to this, we're going to say number of shares issued will be 4.8 million plus 1,000,000 minus the 250. And then whatever you get, you times it by 18 cents. But here we don't minus the 250 because they said they qualify for final dividends. So we must include those shares when we calculate final dividends. Now, here our final dividend will amount to 1,044,000. Here's a question now. Where do we record final dividends? Final dividends will be recorded in your retained income note as recommended of final dividends, and the amount will be 1,044,000. It doesn't stop there. Most of you just stop there. No, it doesn't stop there. Final dividends are also recorded in trade and other payables as shareholders for dividends, and the amount will be 1,044,000. That's it. Let's move on. Additional information and adjustments that still need to be taken into account. The first one, a customer has prepaid the service fee. Remember, a service fee has three names from grade 9, that is. It is called a service fee, fee income, or current income. I'm going to go and look at my pre-adjustment trial balance just to see what they actually called it. They called it fee income. Okay. So that is the fee income that has been received thus far. And here they say that this customer has prepaid that fee income. Fee income, it's income we receive for providing a service. So I'm guessing we were installing the motors. Oh, here it says for the service to his motors. But that service has not yet been carried out, but we've already received the money. So this 2.8, can I say it's income? If you say yes or no, why? Can we say it's income? It can't be income. Have we earned it? To earn it, we must have serviced his motors. Did we service his motors? No. Now I've got a video on adjustments. Check it out. I think it's 1 hour, 25 minutes. Or otherwise, just go under adjustment and they separate a lot of activities given there as well. Sorry, I have a bit of flu. Sorry for coughing continuously. So this 2,800 is not income, but already it was received. And if it was received, it means that it has already been included in the fee income that we have here of that 372,600. So we need to subtract it because we didn't earn it. But since we received it, it means that we owe that person their money back or the service. So we call it a deferred income, which will be recorded where? In trade and other payables. But here they wrote it as income received in advance. So you just open brackets and just put it there. 2,800. I don't know what's coming next, so that's why I'm just leaving that bracket open. That's it. Number 2 says it was discovered that water and electricity. What is water and electricity? Income or expense or asset or liability? What is it? It's an expense. So it should appear under operating expenses, right? Is it there? Yeah, there it is, 79,400. Okay, so what's happening here? They say that the account was received. So you receive an account from municipality, and it's normally when you receive an account, it means the service has already been done for you. So you have had water and electricity. So when you receive that account, it says that for February of 7,200 was never paid. So the account will show you what has been paid and what has not been paid. Here, we receive this account. Note that when you receive the account, it simply means you have used the services already. So we have used the services. So we have incurred the expense. But the problem is we did not pay for it. Remember that 79,000 something for water and electricity. That represents water and electricity that has been paid. And for us to recognize an expense, we don't recognize it because it has been paid. We recognize it. The characteristic for you to recognize an expense is that it needs to be incurred. So we've used these services. So we've incurred the expense amounting to 7,200. But that 7,200, because it was not paid, it was not included in that 79,000. Forgot the value. 79,000 what? 400. There it is. So I'm going to add the 7.2 because I've incurred it, even though I haven't paid it, but I've incurred it. But because I've not paid it or paid for it, it will be recorded as accrued expense. Where do we record accrued expense? In trading other payables. There we go. Guys, once you've watched all the videos where I explain all the adjustments and all the examples, income statement examples and everything, trust me, when you start doing question papers, they will be so easy because you're rich in knowledge. Wealthy. Actually, you have wealth of knowledge. Let's go to number 3. It says the company donated goods to a local charity. Two accounts that are affected there. What are they? Donations and trading stock. Which one do we debit? Donations. Why? It's an expense. Trading stock. Why do we credit it? Obviously, we debited donations. We have to credit trading stock. Why do we credit trading stock? It is an asset, and an asset decreases on the credit side. Good, right? But here's the thing. Donations must be recorded at which value? It must be recorded at cost price. If you don't know how to calculate cost price given the markup, please go to my YouTube channel and Google this markup. MARKUP. It'll show you a pinkish table. Make sure you watch that table until you understand everything on that table. Okay? Now, that table, once you have watched it, come back to this question. They say this meant that a gross profit of 12,400 was not made as the goods were not sold. So gross profit equates to the markup. So that 12,400 is the markup, percentage-wise. What is our markup? I asked you to highlight it a long time ago. It's 200. So that 12,400 is the 200%. And we don't want the 200%. We want the 100%. How do I get the 100%? It's because, guys, donations are recorded at cost price. And that is your gross profit. To get the cost price, you will take that gross profit and multiply it by 100 and divide it by the markup. This will affect your trading stock. And I'm going to start with your trading stock. Please note that as per the pre-adjustment trial balance for this year, trading stock is at 695,000. I'm going to take that 695,000 and subtract the cost price of these goods that are returned, which will be 12,400 times 100 divided by 200. And that'll give me the cost price, which amounts to, I don't know how much. But that cost price will also affect donations. Donations will be recorded at cost price. I won't show the calculations here. I'll just give you the value, which will be 6,200. You see, guys, this is easy, eh? Yeah, easy. Just remember the basics and then trust me, you'll flow like water. Now, number 4, it says an amount of 32,000 for the advert was placed, that was placed in the local newspaper in February, has not been paid. So first of all, that affects advertising, right? And February, this is where I think the examiner made a bit of a mistake because they didn't mention which February. Is it February 2022 or is it February 2023? The date there is very important. And that's what the examiner left out here. All right. So when you do this paper, please do include the February 2023. So that's what I told my grade 10 earlier on before I looked at this memo here. Um, so February 2023 obviously falls in the current financial year, and there was an advertising expense of 32,000. So I'm going to go to advertising because this was not paid. It means that whatever advertising I've got, which is 516,000, that 32,000 was not included. So I'm going to include it. And since it was not paid and we have incurred it, because February is for the current year, we've incurred it, but we have not paid for it. What is it? It's accrued expense. Where do we find accrued expense? In trade and other payables. There we go. So you add there 32,000. I'm not done reading that. I'm going to continue. And then what do they say? The newspaper had purchased the parking garage door motor for 7,500. So the same newspaper that we use for advertising, they bought a garage motor, door motor from us for 7,500. That's 7,500 because they bought it for that is the selling price to us. And remember, when we sell goods, 4 accounts are affected. That does not change. Guys, stick to the basics. Trust me, you can answer any question paper as long as you stick to the basics and you understand everything and all the definitions that I gave you. If this is your first time checking out my channel, go to all the definitions, all the adjustments, and make sure you understand them. You have less than a week to do that. Once you understand them, it'll be so easy to apply the concept that you have learned, and you can apply them in everything. This is for you guys to make life easy for you, okay? Now, it says the sale has not been recorded, as it was agreed that Mkhize Motors could deduct this amount from the amount owing for the advert. Remember, we owe them 32, but we have recorded that already. You stick to the basics first. Stick to the basics. Don't be confused by it'll be deducted from the advert. Stick to the basics. When we sell, which accounts will be affected? It's sales and what? And bank. If it was purchased for cash, but was this garage door purchased for cash? Garage door motor? No, it was not purchased for cash because they said we must subtract it from the advert, right? So it's basically it was purchased on credit, but you need to be careful. Well, think about it. It's sales and debtors control. We debit sales. No, we debit debtors control. We credit sales. Now I'm gonna focus on the credit, which is sales. When you credit sales, sales is income. It increases on the credit side. So I'm gonna go to my sales and increase them by 7,500. Apologies for coughing. Sorry, I've got flu and I need to record this today. So that's why I have plus 7,500 over there. Ideally, they should be owing us. When they owe us, we're gonna come here. We're supposed to go to trade and other receivable, and we're supposed to add that 7,200 here. But we can't. Instead of them owing us, we're gonna deduct what we owe them. So we're gonna go to trade and other payables. Remember, we're owing them 32,000. We're gonna take that 32,000 and minus 7,200. So we owe them, they owe us. So we took what they owe us and subtracted it from what we owe them. Yeah, that's a bar, right? I know. Uh-huh. And that's it for the first two. What's the other two that will be affected? Cost of sales, correct. What's happening to cost of sales? It'll increase. At the same time, what goes with cost of sales? It's trading stock. Trading stock, what will happen to trading stock? It'll decrease, but it'll decrease at cost price. Were you given the cost price? No, but you have the markup, right? So how do you calculate the cost price when you're given the selling price and the markup? You take the selling price, you multiply it by 100, you divide it by 100 plus the markup. What was the markup percentage? It was 200. So do you agree it will be 100 divided by 300? Good. Got it? Now that will give you your cost price. Obviously, it reduces trading stock because we sold it, right? You got it. Yeah, sure. Good. So what will happen to cost of sales then? It will increase because we are selling rate 9 and 10. Cost of sales only increases at cost price whenever you sell, right? Done with that transaction. It wasn't difficult, was it? No, right? Yeah, I know. Did you watch all the videos? If you did, she'll be easy. All right. I'm done with that. Let's go to number 5, consumable stores. The first one says the bookkeeper forgot to reverse the transaction for consumable stores on hand on the 1st of March 2022. So what do we do then? I'm going to go to consumable stores expense we have here, which is that 45,700. And I'm going to add that consumable stores that was given to us from the beginning of the financial year, which is that 1,250. So I'll just, excuse me, edit here, and I will add it to that 45,700. Okay, we good? Mm-hmm. That's it, right? If I had inventory, I was gonna, and they gave me consumable stores on hand, I was gonna subtract it there because every entry affects at least 2 accounts. Let me just finish this. 5.2. It says 2,250 worth of consumable stores were ordered and recorded. The thing is, guys, when we have ordered and record, we only record what we have paid for. Do you get it? We only record what we have paid for. But then they said ordered and recorded. I don't know why they didn't say ordered and we paid for it. But anyway, when they say that it was recorded, they simply mean that it was paid for. Okay. If it was ordered and purchased, we know that in that case, it means it was purchased on credit. I think they were supposed to be clear on this. But anyway, it's fine. I don't know why they wanted to trick you with that. However, it has not been delivered as the supplier is still waiting for certain items. So here it reduces consumable stores on hand because it is included in that 45,700. So we just need to exclude it. The reason why someone could have said excluded, it was included. And remember, as much as I say only cash or what was paid will be there, also what we bought on credit will be there because what we bought on credit will have been recorded in the creditor's journal. Do you understand what I'm saying though? You got it, right? So I wouldn't blame you if you took that 2,250 and you subtracted it from trade creditors because they were not specific. This is the argument I had with the great tens earlier on because they were not specific as to how these consumable stores were purchased. And that should have not been a trick, honestly. The trick should be on how you account for it. Okay. So I don't know how it was marked, but I feel like if it was there in trade creditors and you subtracted it um because you don't owe it for the current year. You don't owe it because you have not received the item yet. Okay. At the same time, I will say that since you subtracted it from there and you've already paid for it, that is if it was cash. So you're gonna go to bank and then um actually they were not specific as to how this was purchased. It doesn't affect your bank. But because we have paid for it and we have not yet received it, it becomes a prepaid expense. And where do we record a prepaid expense? In trade and other receivables. That is because they owe us. Okay. But you could have subtracted this from, um, I don't know why I did that. You could have subtracted this from trade creditors. We had a bit of arguments with my great hands. And the argument was actually valid. Okay. And I agree with him. But anyway, I'll explain according to what the memo says. I just want to make sure that I correct the format here. So that 2,200 will be recorded here excuse me, as prepaid expense. Okay, let me just continue with this. Um, just want to go back to here. It was 2.8, 7.2, and that. Okay. And here we're gonna have a prepaid expense. Why does it show me accrued income first? I want the prepaid expense first. Apologies, guys. Let me just fix this quickly. Now it should be fine. Let's see if it works. And this is what we will have as a prepaid expense. Got it? You good? Sure. Sure, sure. That's it. Can I move on? Yeah? Okay, cool. It says that the annual stock take indicated the following was on hand on the 28th of February. So they have consumable stores were that. That one will normally record it in the inventory note as consumable stores on hand, but we're going to use that because it was on hand, it was not used. Therefore, it's not an expense, so you reduce your expense by what was not used. So your expense will be 42,714. I can't even raise my voice here. Too bad. So that 1,960 will be recorded as consumable stores on hand in the inventory note if it was asked, but here it was not asked. Okay. The next one, they say trading stock amounted to 672,000. So I will go to my trading stock and the workings, right? So I will take that 695,000 minus 6,200 minus, what was that? It was 2,000 something. I forgot it was 2,000 how much? 2,500, I think. And it will give me trading stock adjusted, which will amount to 286,300 compared to what was accounted, what was counted, which will be 672,000. So you'll notice that what was counted is actually less than what was recorded in our books. Therefore, the difference is a deficit of 14,300. Where do we record trading stock deficit? Under operating expenses as what? As trading stock deficit. Don't forget the word deficit. Don't forget that. Okay, deficit, which will be 14,300. Got it. We good. The next one, they say depreciation on equipment is calculated at 20% per annum using the straight line method. Now, when I explained this earlier on to my grade 10s, I said to them, you needed to calculate, first of all, you need cost at the beginning of the year and accumulated depreciation at the beginning of the year. They were given to us. Cost was 1,160,000, remember? If you're wondering where that information comes from, it comes from here. Remember, I highlighted them at the beginning and I said we will need to use those. And then you will minus accumulated depreciation at the beginning of the year. It'll give you carrying value of 225,000. Now, someone might say, but why go through this when you could have just taken that 1,160,000? Guys, I'm sure you have watched all my videos. You need to calculate carrying value at the beginning of the year first, please. And then you calculate this year's depreciation, which was quite easy because you don't even need that 225. You just take 1,160,000, you times it by the depreciation rate of 20% because they told you we depreciate on straight line. Straight line is the cost method. Look at our depreciation. It is 232,000 and it's higher than carrying value at the beginning of the year. Now, if you said we didn't need to calculate carrying value at the beginning of the year, you're going to take that 232 and say it's your depreciation, and you will be 100% wrong. Imagine being wrong with a distinction, hmm? Because you don't follow the principles. Stick to the principles that you've learned in grade 10. So current year depreciation will not be that 232,000. Because that 232,000 is more than 225,000. So we're going to limit it to the carrying value at the beginning of the year minus 1, which is that 225,000 minus 1, and that will give you 224,999. That is your current year depreciation. Where do we record depreciation? Under operating expenses, and you just put it there. See? 224,999 for 399. Just like that. Zoom. Let's move on. It says here, it was agreed that the rent will only be increased by 5% on the 1st of November 2022 if the tenant agreed to pay a 9,000 deposit. The deposit was received. So by saying this, it means that that 5% is effective, but not recorded. The rent for February is still owed by the tenant. So when you receive a deposit, you debit bank and you credit the liability. So the liability here will be deposit, rent, income. But some student will actually record that as income received in advance. And I don't think that would be right. I think you could have recorded it okay, deferred rent income. Internet is bad today. Now they say rent for February is still owed. Remember, the deposit doesn't really affect our income for now. Okay, it doesn't. It doesn't at all. So as I've said, that'll be deferred rent income. Um, and I said it doesn't affect our income at all for now. So still, we are still owed. We are still owed rent for February. That means we have the rent income that we've got in the pre-adjustment 12 months, so our statement of profit or loss or income statement of 89,200. It is only for 11 months. Had the deposit not been paid, it was going to be so easy. We're going to just take that 89,200 and divide it by 11 and add whatever we get there. But we can't do that because the deposit was paid. It'll be it'll be necessary for you to draw the timeline. With your timeline, you start with the beginning of the year, which was the 1st of March 2022. The end of the year will be 28th of February 2023. But note that we are missing 1 month, which is the month of February. because we have received rent only for 11 months. Rent only increased by 5% on the 1st of November. Sorry, guys, my internet keeps on disconnecting me. I think it's because of the bad weather outside. I really apologize. It's not me. Okay. But I have to finish this. But anyway, from November until the 1st of February, let's count it. It's November, December, January. We don't count Feb because it was on the 1st. Rand was already at 105% because it increased. You got that, right? So all of this will be equal to what we actually received, which was 89,200. We could. We don't know when the deposit was received. But from what they said here, it was actually received this year. So it's not part of our rent income. That deposit, it is kept in trade and other payables or in our bank account until the tenant moves out. If there's anything damaged within our space, we're gonna use that money to renovate whatever the tenant has damaged. Otherwise, we're gonna pay it back to the tenant if there was nothing damaged. So we put it in that account. That's what the deposit is. You got it. So it doesn't affect our rent income for the current year, except for the fact that it increased by 5%. So I'm gonna add all of that up. Guys, you did math. You did math. So if you did math, you will know how to deal with this, especially on the left-hand side. I will first start with 3 multiplied by 105%. It'll give me this, and I will just add it with 8. And then it will give me that. You add the coefficients, you keep the variable as it is. The variable there is x, so I'm gonna keep it as it is. So I will have that 11,15x is equals to 89,200. Then divide both sides by 11,15x, it will give you 8,000. This 8,000, it is the rent before the increase. So to get that 1 month rent, 1 month's rent, we're gonna take 8,000 multiplied by 105%. It'll give us 8,400. So that 1 month's rent will be 8,400, which is what is missing. It is our income because we have let the tenant stay in there for a month and we have not received the money. So it's still income. We have earned it. It's ours. So we're going to go to rent and increase it by that 8,400. But that 8,400 is accrued to us. We have not yet received it. So we're going to record it in trade and other receivables as accrued income. Okay, done with that. Now it says the bank statement for February was received. Okay, bank statement's about cash, all right? So if we had bank, this will also affect our bank account. It indicated the following had not been recorded. Okay, highlight that. By the business. Bank charges is an expense. So you're gonna go to operating expenses and look for bank charges and add that. And then it says what? Interest on credit balance for 50. On credit balance, understand our bank, when we have money in our bank, we debit it. Okay, you don't know this yet. But when we deposit money into our bank account, the bank credits it because they owe us that money. Okay. So interest on a credit balance as per the bank statement, it means it is interest on favorable bank balance. And interest on favorable bank balance is income, and we record it as interest income. It's basically interest on savings account or current account. Okay. So we're gonna add it to interest income for 15.